Welcome to our special session. I'm your host, Pallavi. This is the sixth part of our ongoing series with Mirai Assets Mutual Funds. Today's topic for the webinar is avenues to invest in US markets. I'm happy to be joined by Siddharth Srivastav, Head ETF Products, Mirai Asset Investment Managers India Private Limited. Siddharth has over 10 years of experience in financial services and is responsible for the ETF business of Mirai Asset India AMC. I'm also being joined by Mohit Gang, co-founder and CEO of Moneyfront. Mohit is an investment expert and has personally handled HNI and ultra HNI portfolios. He has rich experience of working with leading banks like HSBC and Citibank. Welcome, both of you.
Thank you.
Thank you so much, Palji.
Let me begin with you, Mohit. We are seeing several funds being launched in India which provide exposure to global markets. So why do you think Indian investors should actually embrace investing in foreign markets like the US?
Oh, thank you, Pallavi. Good morning once again. And look, honestly, I think there is no comparison when it comes to US versus any other market in the world, right? So globally, US is at a very different scale altogether. So if the global market cap, let's say, is roughly around $60 trillion, US is out there at around $33 odd trillion. It's almost like 55+% of the global market share when it comes to market capitalization. India is just at around $3 trillion, right? So you can like compare the scale and size of two economies. It's at a very different level. Even when it comes to technology, any new innovation, US is at the forefront of all changes globally, right? It leads the world technology indicator. It leads the world research and development expenses. US budget is almost like $500 billion a year on research and development every year, right? And the close distant second will be China when it comes to market cap or any other parameter. Right? So there is a long way for India to catch up. And hence, the reason for any investor to go out and invest in US market is an absolute must do, right? There's no reason why someone should not be participating in a global economy of that size and proportion, which is leading the innovation parameters, which is leading which is at the forefront of technology and where all your big names of the world are. The benefits of investing globally could be manifold for investors. One, obviously, is the underlying market's performance, its robust strength, which goes unparalleled in case of US. The second part is you also benefit if the currency depreciates. Now, Indian currency, for whatever reasons, for last 20, 30 years has been depreciating at almost like 3.5% against US dollar on an average. That additionally adds to an investor's return along with the underlying return. So the currency benefit also accrues to an investor. And the last and the most important part, which I'm sure Siddharth will also agree to, is the diversification benefit. As investment advisors, our key role is to tell investors to go out, diversify their portfolios, hedge their risks, don't invest in related asset classes, invest into asset classes which are non-correlated. And here comes an international diversification, which is to that magnitude and proportion. So the case for investing in US or internationally is absolutely a must case for any investor.
Sure. In fact, this is established by Mohit, that what are the benefits of global investing and why should investors be looking at it. So let's now talk about ETFs. And Siddharth, I want to ask you this question. What are the advantages which an ETF provides while, investing in foreign markets and why fund of funds should be chosen?
So ETF basically tracks an underlying index. So it provides a very method-driven, transparent, rule-based approach to take exposure in foreign markets, right? For example, Mohit was alluding to the fact that we don't have tech companies of which products we own, services we own. So people want to take exposure in markets, especially like US, to basically invest in such company, be it a tech-centric portfolio or be it a broader portfolio. So an ETF provides a rule-based approach to take those exposure. Either you can take a broader exposure through products like S&P 500 or S&P 500 Top 50, or you can take a tech-based exposure through product like a FANG Plus or a NASDAQ 100. And this, through ETF, you can do it in a very low-cost manner, in a very transparent manner. And investor knows what they are getting into. For example, they can take a focused exposure in theme, sector, or in a market in general. Also, one thing which is now happening in India, but has happened in US in last couple of decades, is that passive funds are outperforming the active funds. It has become very difficult to generate alpha in developed markets like US. So at a low cost, if your ETF is outperforming a high cost active fund, then it becomes a no-brainer to take exposure in these markets through an investment vehicle like an ETF. And on top of that, now a lot of people are also launching fund of fund. So in India right now, people are still not very well versed with how ETF work, right? A lot of people don't have demat account or do not prefer to buy and sell on the exchange. So for them, even the fund of fund is there, using which people can take exposure in an underlying ETF. They can use facilities like SIPs, STPs, etc., and they can do that without having a demat account or logging onto their broking platform and buying and selling ETFs on the exchange. So these two things, ETFs and the fund of fund based on ETFs, are right now two good ways to take exposure in markets like US.
Sure, sure. In fact, this brings us to the question of, for whom is it suitable? So this question is for Mohit. Is it suitable for everyone? And what should be the, ideal investment horizon? How much portion should an investor allocate into such global funds?
Oh, absolutely, Pallavi. I think it's suitable for you. It's suitable for me. It's suitable for Siddharth, for everyone, right? So there's no question why you should not be, as I established in my first revert to you, that there's no question why one should not be going out and investing when there is a huge market outside, right? You can't be just looking inside the well, and you can't be like a frog in your own well. Basically, you'll have to go out and explore the world. So in terms of suitability, for any investor who's an equity investor, right? I think that's the first hypothesis out here, that if you're an equity investor, then you have to definitely diversify your portfolio, go outside India. Geographical diversification is a very important form of diversification, and explore markets like the US market, right?
Okay.
So that definitely is a must. Now, how much to allocate, what age group it is suitable for, and so on and so forth. For all those questions, I think those are very specific questions and will differ from each investor to each investor, depending on his or her risk profile, his what do you say, financial plan and financial ambitions and goals, and so on and so forth. But at a very generic level, if I have to revert on this one, I think each investor should have a allocation. It could be anywhere from 5% to 20% in one's portfolio, depending on what kind of risk does he want to take. So aisa nahi hai ki there are no risks in global investing, right? So there are risks. One has to be cognizant of it. There is a currency risk, there is a market risk, there is an underlying risk, right? And plus, when you go out, you obviously are not as knowledgeable about those markets as you would be about Indian markets. So your knowledge about your own country is a little higher than what your knowledge about US is or any other market is, right? So you have to totally rely on the expertise of a fund house, that they're catering to you the best possible product. They are doing their own research, and either it's a fund of fund or it's a direct investment, but they are doing their back end thing properly to give you the best in class, right? So out there are risks, but 5 to 20% allocation, a 10% allocation at all times in any kind of a portfolio, I think that's very good from a hedging purpose also, and from benefiting from the investors, what do you say, in a long term sense, benefiting from the overall growth of those markets. So I think that's what one should do.
Surely. So it offers a lot of benefits, diversification, and as you mentioned, Mohit. So another question which comes up is, that Indian markets, global markets are trading at premiums and higher valuations. So Siddharth, is it the right time to invest? I mean, what do you have to say on the timing, and what should investors do at this point in time?
So Mohit already pointed out to very, very interesting fact that when you're investing in global markets, you are investing in markets which are much bigger than India, which have good growth opportunities. Plus, you also tend to benefit from currency depreciation, right? And also from a taxation point of view, also you get more benefit if you have invested at least for 3 years, right? You get taxed and get a benefit of indexation, right? So thinking of all those point of view, I think one should only look at investing from a long-term point of view. At least, let's say, for a 5-year period, if you're investing in global market like US. And once you think from that point of view, current valuations or whether the markets are trading at premium right now or not, that particular debate dies down a bit. But yeah, coming to that, it's true that markets are trading at premium. They are currently at 15% premium if you compare the current 12-month forward P with the average 5-year, previous 5-year 12-month forward P. So there's no denying that. But see, macros for US economy is looking very strong. It is expected to grow in the region of 6 to 6.5% this calendar year, and around 4.4% next year, which is almost equivalent to what developing economies will grow by in these 2 years. Also, corporate earnings have been very good. There has been an increase in consumer spending. Job data is very good. Inflation is a concern, but latest data show that also seems to be plateauing as expected. So if you are looking at growth data, if you're looking from a long-term investment point of view of at least, let's say, 5 years, then I think even at these current levels, looking at the growth opportunity seems to be the right time to invest, either in a lump sum manner or in a staggered manner in quality companies in portfolio which consist of quality companies.
Surely, but this also, kind of triggers the point that, what could be the possible strategies. So, Siddharth, if you could help us understand what are the various product strategies when it comes to investing in the global markets, and how should investors choose the funds?
So typically, since we are talking about US market, let me stick to US only for the time being. So typically, people when they look at US market, and Mohit alluded to that fact, is that you want to take exposure in tech companies, right? So typically, there are two ways to invest in US market. What people have been doing is, one, they look at a tech-centric portfolio, right? And it can be, let's say, a fan plus company portfolio, or a NASDAQ 100 portfolio, or they look at a portfolio which is sector agnostic in nature, which cover companies across these sectors. Now, the benefits are very different of taking exposure in these two type of products. In tech-based, you may get a higher return. If you look at last 5-10 year data, tech has done well, but that comes with a higher risk, higher volatility. So, first of all, it should suit the risk profile of an investor, but as I said, that it comes with a higher risk. The second point is that if you invest in a sector agnostic portfolio, your returns might be muted a bit, but it's much more stable from a risk point of view, from volatility point of view. In fact, if you look at a sector agnostic portfolio, typically it has had a lower risk across all calendar years in last 10 year or 15 year periods. And that's very interesting. So Mohit was talking about the fact that you can start from 5%, go up till 20% in terms of taking exposure in US market. So either an investor can start from a sector agnostic portfolio if he wants to take a lower risk, right? Even these sector agnostic portfolios have generated double-digit excess return over Nifty 50 in last 10 year or a 5 year or even a 3 year period. So either an investor can do that, or I think what one good strategy is also to invest in both the products, one a tech-centric product and a sector-agnostic product. So you have one portfolio where you can generate higher returns, but it has a higher risk. But there's one more product where you are investing in a sector-agnostic manner, and you are generating alpha, maybe a bit less alpha, but at a much lower risk. So these are the broader strategy when it comes to US market. Yes, there are now theme-based and sector-based funds also which are coming. So there are products launched around healthcare, around disruptive tech also. But these again are more risky. So I think one should think about complementing a tech-based or a sector-based product with a sector-agnostic product, and that's how he can increase his holding to, let's say, a 15 or a 20% in US market.
Right. And everything begins with the analyzing how much risk one needs to take. So Mohit, before we let you go, from your point of view, how do you see it involving in India? Like with regard to the global investing, this whole phenomena, what change have you noticed?
Oh, from our perspective, honestly, we have seen a lot of investor interest because we are out there in the market talking to investors, helping them invest, right? So we have seen a lot of new fund movement going to international allocations, and testimony to that fact, Pallavi, I think is that now in India we have almost 37 FOFs investing overseas. This number 2 years back was about half of this basically, and the AUM is almost touching 25,000 odd crores under this category, right? So it's a massive change in mindset. I would say it's an evolution of an investor's life cycle when they realize that the right way of investing, the right way of having diversification in a portfolio is also to have an international exposure. Plus, I think one of the bigger factors leading to this is the performance of US market, right? No one can deny, and the US markets have like really ruled the roost for last 5-6 years put together. You see the companies, whether be not just technology, and as Siddharth was saying, you should have a sector agnostic and a thematic kind of a drive when you're looking at these markets. So not just technology, but companies like biotech, companies in pharma, companies in different spaces, which are perhaps those ideas are not available in India, right? You would find listed companies in US in such spaces, which in India I think perhaps are like 5-10 years down the line, right? So those kind of ideas when it comes to ESG ideas, nature conservation, water technologies, biotech, there are multiple things, right? So when you want exposure in these kind of things, you have to look overseas, you have to look abroad, and US is the first destination when you ever look abroad. And investor interest has been soaring across these categories, and I genuinely believe that every investor should have a portfolio allocation. 5 to 20 is a range. Consult your financial advisor, and but definitely have one allocation out there.
Siddharth, anything that you would like to add when it comes to the evolution and the change in behavior patterns from the industry perspective? Anything that you would like to add on this?
I think Mohit has already talked about it, and we are seeing a lot of products being launched, providing thematic exposure, providing sector-based exposure, and obviously sector-agnostic exposure. It is up to the risk profile of the investor on which fund he should invest in. But as Mohit said earlier, US market is huge, right? We are just 3% globally in terms of the market cap, whereas US market is around 60% or so. So when you are investing in US market, having a portfolio level investment of, let's say, 10 or 20%, it is important to think about diversifying from that point of view also. Have a combination of a tech-based or a sector-based with a sector-agnostic based portfolio, so that overall risk profile of your investment, return to risk profile of investment even in markets like US is as per your risk profile. So I think right now we have very interesting products. Going forward also, we see a lot of interesting products coming out, not only based on US market, but even based on other Asian economies, Europe, etc. So interesting times ahead for investors who are keen on global investing.
Absolutely. It was a pleasure having you both on the session. Thanks a lot for joining me. Thank you.
Thank you. Thanks, Pallavi.
Thank you, Mohit. Thank you, Pallavi.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.